I'm delighted to be able to introduce the moderator of the session, who will in turn introduce the panelists, Gillian Tett. Gillian is an assistant editor and columnist at FT, and until recently, the U.S. managing editor. Before her time in the U.S., she reported from Tokyo, Russia, and Brussels, so her perspective is truly global. She's been named both Journalist of the Year and Business Journalist of the Year by the British Press Awards. She's a best-selling author. She has another book coming out later this year, and we are delighted to have her get the conference off with a wonderful panel. Gillian, panelists, please come.
Right. Well, that was beautifully choreographed. Good morning, everyone, and welcome to the first panel entitled, Is Confidence Returning? I was talking to a member of the British government early this summer and asked him, what would it take to make everyone in London and the rest of the UK feel much better about the economy? And he suggested that what you needed to see was falling unemployment, rising house prices, a spell of sunshine, a British winner of Wimbledon, and most important of all, a royal baby. And guess what? We've had all five. And if you look around you today in the City of London, you certainly can see signs that people are starting to feel better about the economic outlook. Perhaps more importantly still, you can see signs of an improvement in sentiment in places like the Eurozone, even the Eurozone, certainly the US, and the emerging markets, notwithstanding the recent market wobbles, have remained a source of very powerful growth over the last year. But the big question is this recovery for real? Are we going to see the big fiscal problems derail it? Perhaps most importantly of all, are we going to see politicians essentially spike the guns or rather prick the bubble of any return of confidence and sentiment? And certainly those of you like me who've been glued to the television screens in the last 24 hours and marveling at the ability of American politicians to make your average toddler look really mature know about the risks right now of another bout of market wobbles and another bout of confidence-sapping maneuvers over in Washington. So we have a terrific panel to discuss this issue. On my right, your left, is Willem Buiter, Chief Economist of Citi. On my immediate right is Cairns, who is President International for the markets of MasterCard. Essentially, that means she runs everything outside America, I think. On my left, your right, is Thiam, who's known to many of you as CEO of Prudential. Next to him is Ed Daniels, who's Chairman of Shell UK. And at the end is Alex Friedman, who's Global Chief Investment Officer for UBS. So we have a combination of real economy representatives and financial markets representatives. But I'm going to start by trying to get a sense of what's happening in the real economy, a snapshot of life on the ground, away from the media headlines and the political tantrums, and start by asking Anne, when you look at what the consumers who use MasterCards are actually doing real time with their spending habits, with their credit, their plastic, do you think that we're actually seeing a real recovery right now?
Well, I think we're seeing quite a muted recovery, especially in the US, because basically US consumers don't like instability, which no doubt they're feeling a bit this morning. But basically what you're seeing is there is growth, but it's growth in spending in what people need rather than what people want. So people are spending on food, on fuel, but there isn't that sort of level of growth going on in the apparel side. And also, people are asking, certainly the US spending is indicating people want value for money. So while you've got something like 1% growth in the fast food sector, you have something like 16% growth in the next level up in terms of restaurant. They want good food, not just fast food, which is interesting. Here in the UK, we are experiencing growth. Again, it's in the food and fuel area, a bit more confidence across Europe. the political situation stabilizing here, and you're seeing some slow growth on continental Europe. It's probably the unemployment, the youth unemployment here, which is sort of 23%, I think, on average, that's affecting things. But of course, Eastern Europe is really driving growth, you know, the Poland, Russia, and so on, very, very confident growth there. And when you get out into Asia, the Asia consumers are spending very well. But again, you're not seeing the spend that we saw originally in the luxury good area. You know, if you go to Hong Kong, people are not buying lots of designer stuff. They're choosing what they want to buy. And of course, the travel is down. The airline travel is down out of the UK, out of the US. People are staying home for their vacations. People are actually driving on vacation. The Europeans are staying in Europe. The Americans are staying in America. And the Asians are also staying home. So you do have sort of hotel spending occurring, but it's localized. It's not the big international trends that we've seen.
Right. Well, those of you who were at the dinner last night and heard Mike Milken's compelling presentation would no doubt be delighted to hear that Americans are not picking out on fast food quite so much right now and spending on higher quality food. But one question, if you look back over the last 5 or 6 years at what's been happening in the last month or two, as seen by MasterCard, do you see a sort of flatlining or a steady upwards curve? Or have we seen any acceleration in spending in the last couple of months?
Oh, we've certainly seen acceleration, you know, since 2008. I mean, sort of consumer spending around the world continues to grow at about 5% a year, and that growth goes up to 12% in some countries. But it really is very localized in terms of how the consumers are feeling. So, for instance, while, you know, down in Brazil, you've got the GDP growing at, I think, about 3% or something. They are being affected by the fact that, you know, interest rates have risen there. If you go out and buy a sofa in Brazil, you're paying for it in installments. And now people are paying something like 10% a month for those kind of things. So, you know, it very much depends on the local economy, what occurs. But yes, it has been growing continuously around the world.
Well, that obviously raises a lot of questions about the potential impact of any more market shenanigans as a result of the US problems. But before I turn to that, I mean, Ed, I'd like to ask you, from your perspective, looking at the real economy, do you see confidence returning or growth returning?
So we do. I mean, the energy system of the world is pretty intimately linked with global economic indicators. What we're seeing is a reasonable return to confidence in the US. I mean, the sort of whole shale gas thing has given a resurgence of the competitiveness of the US as a manufacturing base and given a sort of a cost boost to US industry. So we're seeing that filtering through. Other parts of the world, we're seeing a much more muted view. If I sort of travel around the world a little bit, Latin America is pretty challenged, I think. We're seeing struggles there, both in investment, but also if I look through the lens of retail sales or you know, trucking sales for diesel, that's challenged. In Europe, Europe is extremely flat, very flat in terms of demand. I mean, I think I recognize much of the sentiment around Europe, stay-home vacations, that kind of thing. We're seeing pretty flat in terms of demand. If I travel around the world and go to Asia, actually, I think China actually is a reasonable positive for us. I'm seeing perspectives for new projects in China, new sort of large-scale energy projects, but also seeing a reasonable amount of consumer confidence. Certainly our products, of course, are pretty basic needs. The energy industry also, though, has a few areas that I would regard as potential areas of instability. If I think about challenges and issues in the Middle East, I mean, that could cause dramatic changes in energy prices and therefore have a knock-on impact on the real economy. So it's a pretty mixed picture, with the US being probably the star child and other areas being much more variable.
Right, right. Well, I say, listening to you, I'm beginning to think I should learn how to say staycation in French and Italian or German. I don't know if there is an indigenous word there. But I'd like to turn to Alex, because, I mean, what we just heard from Ed is that in some ways, leaving aside China, which we're going to come to later, the US is the brighter spot in the picture at the moment, certainly compared to the sluggish Eurozone. And yet, overnight, we've seen an event which may well take away some of the shine in America. Looking at the situation from the perspective of the financial industry and financial markets, To what degree do you see the current events in America posing a real threat to the underlying kind of improvement in sentiment we've just heard from Anne and Ed?
Let me just take a step back before I answer your question directly, and that is that I think what Ed said is basically the story of deleveraging. So if we look around the world, the U.S. private sector has delevered the most. It's pretty much done as far as we can tell. Yes, the public sector has levered up, and that's got its issues, and we're seeing some of that play out overnight. Europe, deleveraging is way behind. It's still got quite a bit to go, I would submit, on the banking side. And in China and in some of the emerging markets, because the West and the developed markets delevered, they relevered. And we're starting to see some of that unwind and some of the slower growth that follows. In terms of the U.S. being the locomotive of the train, the recovery train, I don't think what happened overnight really matters too much. As an investor, that's what I would say. There have been, I think, 17 funding gaps or shutdowns in the last 40 years. If you look at what the market's done in the, say, most recent dramatic one of 95, 96, it was pretty limited. What becomes scary is if the rhetoric increases until you get to the theoretical October 17th deadline. I don't think there is much, if any, likelihood that the U.S. defaults. I think if need be, the president would claim he has emergency powers under the Constitution to protect the Constitution and require the Treasury to avoid a default. So in fact, I think it's a buying opportunity and the U.S. recovery continues.
Right. And what about its impact on consumers and companies? Do you think that's going to in any way make people more fearful and less willing to spend?
Yeah, that's the question which I don't really know the answer to. I mean, in a sense, the whole recovery is a confidence story. And if confidence is truly undermined, then you got a problem. But I think Americans are so jaded at this point about politicians in D.C. that they kind of ignore it.
Okay, well, if your expectations have already been dashed, you have no more expectations to lose then. But before I turn to Willem to ask him about the real economy, because I'd love to hear your view about the impact on this, can I just ask so, but what about the prospect of a new market jolt as a result of what's going on? I mean, do you think there's a chance we see a sudden bout of volatility again as a result of what's happening?
I hope so, so that I can buy.
So trading revenues can go off again?
No, so that I can invest. Really, I mean, this is an opportunity, I hope, for some emotional pullback so that a long-term investor can be reminded that we're on a recovery story. Global growth is recovering. In fact, the markets were down 2-3%, I guess, in the last 7 trading sessions. They're pricing in this. In fact, Asia was up this morning. So I don't think people look at this and go, my God, something fundamental has changed. They say, politics again in Washington.
Right, right. Well, that's a great thing about expectations being rock bottom low of politicians right now. I was very amused because someone did a survey of American CEOs a couple of years ago and asked them which institutions they ranked as highest and lowest in terms of dealing with the global crisis. And Congress came second bottom on the list. The Chinese government, interestingly enough, came third. So, but Willem, before we talk about issues like China and emerging markets with Tidjane, how much of an impact do you think the current tensions in Washington could or could not have on the real economy? I mean, are you expecting to see consumers start to become more risk averse or more
in and of
cautious
itself,
about spending?
this is just an embarrassing manifestation of political dysfunctionality, but not terribly serious. If it doesn't last too long, that's one. If after a week both sides declare victory and start paying the government again, and the main thing is that it does not raise the market's perception, or let alone the reality, of an accident on the debt ceiling. Right? There's no such thing as a short-lived, technical, easily remedied default for the US government. This is not Greece, right? This is not Argentina. Right? So that is if you're on the tail risk that has become slightly higher as a result of this. But I still consider it inconceivable, even in the land of the politically immature, that the US Congress would break the full faith and credit of the United States government.
So are you in the camp of people who think that the recovery is for real? I mean, is confidence really...
It is for real, but the political classes are trying to their best to destroy it, right? In the US, but also in Europe. Right? Nothing has been happening in Europe for months because Germany was going to have an election. Now, they've had an election, but it's going to take weeks, possibly months, before they have a government. So still no action is being taken, and the necessary deleveraging, which is a precondition for real growth in Europe, right, is not taking place. So yes, well, the UK is recovering. There's a proper recovery. One-sided, not ideal, but no, some demand is better than no demand. But the euro area simply has a pulse, right, instead of flatlining. So that's good news, but it's not a recovery in the sense that the output gap is not getting lower, the utilization of labor is not increasing. So it is no, less than 1% growth probably next year, or maybe just about 1. That is pathetic, right? That means a wider output gap, increasing this inflationary pressure. So, and no growth in Europe, therefore, on a serious scale until the deleveraging has taken place in the banking sector, in the sovereigns of the periphery, and that will take at least a couple of years. We won't have the asset quality review for the banks, the balance sheet assessment, and the stress test until November, October next year, right? And then, of course, the actual recapitalization of the banks will have to take place. And only then will we be able to start growing properly. So it is modest, but you know, the BRICS have all slowed down, but not fallen off the wagon. So depending on which way you look at it as good news or bad news, China, the elephant, right, the other elephant, so to speak, faces 3 challenges where we have to see whether they can handle them. They have to let the air out of a credit bubble, right, without bursting the balloon. That's not a small order. Second, they have so far kept demand going by adding to excess capacity in sectors where they already had excess capacity. It's a totally old-fashioned stimulus, you know, heavy lifting infrastructure, state-owned industries funded through the banks. Right? This is the ultimate non-rebalancing. And then, of course, the long-term rebalancing, we hopefully get something in the next Congress in November, but we haven't seen anything yet. Neither the US nor China are rebalancing. And so from that point of view, growth is there is a recovery. 2008 is a long time ago, but this is still modest and vulnerable with most of the risk on the downside.
Right, well, thank you. Well, obviously China is an issue which many of you in the room will be watching very closely. And the state of the emerging markets has provoked more dispute recently because in many ways that was a bright spot 3 years ago, and yet we've seen a lot of market wobbles in the last year. Tidjane, are you still optimistic about the emerging markets right now? Do you think they can provide a meaningful source of growth for the global economy?
Well, Gillian, we are, because starting with the US, several of my co-panelists have commented on the recovery. We believe there is a recovery. Things are better. The current episode, I think the market will look through it. I agree with Alex that it's all in the prices. And actually the market has gotten used, and the economy, to operating with Washington being in the state it is, and nobody expects any improvement. That has not stopped the recovery that we're talking about. All that has taken place against that background. So that's one. The US will be okay. I think China is okay. They're trying to engineer a soft landing. And I am more comfortable with China growing at 6.57%, which is still very good across the cycle, rather than doing 10, 9, and then 3, 4. And I think that's exactly, that swing would be politically unmanageable. And that's exactly what the Chinese leadership is trying to avoid. I acknowledge the credit bubble, but keep in mind that savings rates in China are 50% of GDP. So managing the Chinese economy is a completely different task from other countries in the West where saving rates are much lower, is structurally healthy. And if you think about foreign capital, the foreign ownership of the equity market in China is 2%, 40% in India, 30% in Indonesia. So it's actually a potential upside because they could actually trigger an inflow of foreign capital if they need to. So they're in a very different situation from other emerging markets. Now, if you look at the other emerging markets, they've been the great, in a way, the winners are vulnerable because if you're a winner in globalization, exports were a big part of your current account surplus. So if the economy slows down, you're more than proportionately impacted. That's normal. And if you look at the 13 countries where we're active in Asia, only 2 are in a current account deficit. It's India and Indonesia. All the others are still in a surplus. Hong Kong +1, Singapore +18, Malaysia +5.8. So fundamentally, they're just there waiting for a US recovery, which will sustain China and help them grow again. And we're not worried about the tapering because there will only be tapering if there is a US recovery, which is very good news for the world economy. So as long-term investors remain positive, if I may just 30 seconds more, you have to think about the drivers of all this. It's productivity of factors. Countries that have a reserve of increasing productivity are better placed. And the drivers of the Asian growth Take demography, which is something we know for certain. The average age in Indonesia is 29. Average age in China, 36. Average age in the US, 37. Average age in Europe, 41. Average age in Japan, 46. That is almost a straight line of world growth. You know, there is a very strong correlation there. Africa, 18, by the way, average age. So you've got 10 workers for every pensioner in Indonesia. You've got 3.7 in Europe. You've got 2.4 in Japan. That is the long-term driver of that story. The urbanization. Every time someone moves from the countryside to a city in Asia, you've got some GDP growth built in there. And that driver, which has driven China, is still underway in Indonesia and in other markets. And that is not dependent on the gridlock in Washington.
Right, right. Well, I must say, apart from everyone thinking that Eurozone is flatlining, you're a pretty optimistic bunch at the moment. Is anyone concerned about China and see risks there of it potentially? Okay, right, well, let's start with interesting, the two financial markets. Okay, Alex and then Willem, yes.
Yeah, I mean, I guess concern is a relative term. Are you concerned that it's going to grow at 6.5% instead of 7.5%? I wouldn't be so concerned about that, but I imagine the markets would react with a lot of concern. What concerns me is two things. One, the need to deflate a credit bubble, which Willem mentioned, which is never without volatility. And two, associated with that, a recapitalization of the banks in China, which I think will be needed at some point. And how that is done, we were discussing it earlier. I don't know, but maybe they'll sell down U.S. Treasuries. That had been kind of hard to imagine a while ago, but now I could imagine it, at which point the Fed policy would be being slightly dictated by China, and they'd have to taper, they have to be looser for longer. And so yeah, I'm a little concerned.
Right. Willem?
I share these concerns. As I said, a credit bubble of the magnitude that we're seeing in China is very hard to bring under control. It's really unprecedented. The banking sector in China relative to GDP is now significantly larger than in the US. Right? And this is still financially undeveloped country. So the regulators are not on top of it. So it has to be handled, and it will involve recapitalizing the banks. I think the sovereign will do that. So the risk of a crunch is there. It doesn't have to happen, but it is there. Similarly, we have to find a way of substituting either investment demands in the service sector and in other non-tradables for the sort of heavy lifting infrastructure and state-owned enterprises investment, which is currently driving the recovery. And again, this is possible, but we have to somehow get households and SMEs to spend more on consumption and investment. And it requires encouragement and policy support. And we haven't seen that yet. Right? A lot of talk, but so far no action. So if we get the action, and China moves slowly, but when it moves decisively, I think, so I'm certainly a long-run optimist. Right? They may move to 6.5% by the end of the decade in terms of sustainable growth, but it's still a fantastic number. This is a country that has peaked in terms of its population of working age, right? It still has 250 million people to move from the countryside to the cities, but it's still, I mean, it's remarkable that you can confidently anticipate growth at 6% or thereabouts for another couple of decades. But they have to do the transition smoothly if they are not to drag the world economy down, because they are now large enough to do that.
But I mean, talking to Ed, I mean, do you see, in terms of your data on the ground in China, do you see any meaningful shift in behavior in the last few months?
So, I mean, I think there have been wobbles in China if we go back a few months. I mean, the great thing I see in China is if you're on the ground, there's an aspiration. There's a desire to grow into the middle classes. There's an urbanization going on in China that we've never seen anywhere else in the world. And so we look through the energy lens, we're seeing buying of vehicles and cars, we're seeing that translating then into gasoline sales and into lubricant sales. And those. So on the ground, you have this massive aspirational desire to get better jobs, to urbanize and to grow and to, the designer handbags and all the usual accoutrements that we put onto the middle classes. So I see that as being a fundamental driver of demand. And if we can get government policy right in China, I think you can unleash the 6-7% growth for quite a considerable period of time.
Right, right.
Yeah, I feel the same as Ed. We're seeing, we see massive growth in China. Part of our business is there's a shift from cash-based economies to electronic. And that also drives growth in our business as well as just, the pace of change of the economy. The urbanization affects that as well. And when you think that something like 85% of the world's consumer transactions are still done in cash and paper, you can see that there's a huge shift to occur. And our studies show that it costs a government, it costs a country up to sort of 1.5% of the GDP just to print this stuff and move it around. And so there's actually a big gain to be had. So we remain bullish on China. Obviously, we'd love it if China, the World Trade Organization approach to China, opening it up in terms of the payment space would be very good for us. There's still, it's still unclear when that would happen and how it will happen. But, I'm optimistic that it will happen.
Gillian, just lest we get completely obsessed with China, let me just put in a plug for sub-Saharan Africa. It's the one continent. It's the one continent that really has surprised on the upside, even throughout the last since the recession. Really, it is quite a remarkable success story.
Well, I think sub-Saharan Africa is one area where even you can be out-talked.
I was about to jump in and mention that and say that there are plenty of growth pockets reserved for growth in the world. Sub-Saharan Africa, the GDP of Africa trebled in the last 10 years, from 600 billion to 2 trillion. So Europe 10 years ago was 20 times bigger than Africa. It's now 7 times. That is a sea change, and that's continuing. And again, I said 18 years is the average age in Africa. I've got 15 workers for every pensioner. And if you wish, unleashing that growth is not very difficult. It's a lot of investment in basic infrastructure. That's happening, sort of foreign capital flowing in, building that infrastructure. And as you do that, the productivity of factors in Africa is increasing very sharply, generating a lot of growth. And again, it was mentioned 250 million more migrants in China. That urbanization drive and that demography, if growth used to be fed by the US consumer, it's now the Asian migrant who's supporting it worldwide. And soon, in a few decades, it will be African urban dwellers. So I think, yes, there will be wobbles. You cannot go in a straight line, but there's no doubt in my mind that the trend is positive.
I think from our side, we're very bullish on sub-Saharan Africa, well, in fact, the whole of Africa, because there's a huge move to financial inclusion. Governments are driving the change. We've been working with the South African government and just rolled out 10 million cards. A fifth of the population are now sort of getting electronic payments from the government. This will then cause a change in the whole way that the economy spends. And we just signed a big deal with the Nigerian government to actually affect 100 million people in this way. So what's happening in Africa is a very, very rapid change with a very greenfield site that things can change, in the matter of a year. You can see a very different spend pattern, very different consumer behavior, and it's very exciting.
Sorry, Ed,
so I'm also positive on Africa. The but I would bring to the argument is we've got to be extremely careful for a coordinated response on security, because there is an arc of instability in the northern parts of Africa that could very easily spread south, which would really damage and sort of disturb what I see as a very positive growth picture further south. If we don't get a coordinated response around that security, I think there are problems ahead.
And of course, we've just seen in the last week the tragic events unfold in Nairobi, which indicates again the risks that we're facing on the confidence front. Sorry, Alex, you were...
Well, I'm just thinking the unifying two themes I've heard so far is the leverage-deleverage dynamic and the implications, and then the demographic dynamic, because Africa is really the demographic growth story for the rest of the century. The flip side of that is Japan, which we haven't talked about, the third largest economy in the world, with the worst demographics, the proverbial more diapers, sold to the elderly than to babies. And in the short term, Japan looks great in terms of some of its investment opportunities, because they're throwing the kitchen sink from the monetary and the fiscal side at stimulus. But what they're really doing is sacrificing the elderly who hold all the debt in terms of hoping to get inflation, which would destroy the savings. And I don't think we've talked about the big tail risk there, which is that there isn't a handoff to growth. And then all of a sudden you see this 300% debt to GDP turn into a vicious cycle, kind of like theory, I suppose, Greece could, and you end up in a stagflation scenario.
Absolutely. I mean, we've seen some encouraging signals overnight from Japan in terms of confidence surveys and things, but I couldn't agree more. I mean, because one of the questions that are underpinning the issue of Japan, which I'm going to ask you each about, is, what happens if interest rates rise? Because the recovery in Japan and the fact they've kept the economic show on the road is entirely predicated on super low rates and easy money. The same perhaps could be said about other countries too. And that's really one of the big questions. But sorry, I cut you off, Tidjane.
No, I'm just going to agree violently with Alex and say for me that the two big dark spots, I'll make a bad joke, are really Europe and Japan, and both driven by demography. I said average age in Japan is 46. Nobody has yet demonstrated what economic model works. And the fastest growing age group in both zones is the over 85 years old. How is that a sustainable economic model? I don't know. And I added to the political instability, I would rank that as two of the biggest risks for the world economy, because the politics behind that are toxic. If you look at the elections and what's going on, it's very, very difficult. I think part of the answer is really, again, to turn towards the emerging markets and embrace them positively. But if there is not a political leadership driving towards those types of solutions, I think I'd be quite bearish on both Japan and the Eurozone.
If you want to feel optimistic, go on holiday in Africa right now. Is probably the answer. But just before we turn on to the issue of interest rates and Japan and really the need for more deleveraging going forward, can I just quickly ask Ed about the issue of political instability again? Because you made two very important points. One is that we cannot afford to forget about the risk of geopolitical instability. But secondly, it's not just the Middle East, which everyone has been obsessed with in recent years. So I have two questions. Firstly, if you look at a sort of map of the world today from the energy sector, what is flashing most red on your heat map, if you like, of risks and instability? Is it the Middle East risks that we actually know a lot about already, or are you actually more concerned about sub-Saharan Africa or other parts of the world? I mean, Indonesia and...
I see them both, Middle East and sort of sub-Saharan Africa, probably in a similar sort of intensity of colour on your map, for slightly different reasons. Clearly, the Arab Spring has turned into something that we didn't quite expect in terms of what has gone on in the Middle East, and it is a fundamental component in the world's energy mix. Getting stability there is really important for long-term stability on the overall energy system. We're seeing, so Nigeria is obviously somewhere that we have very significant operations, and we're seeing, just these awful sort of juxtaposition of oil theft on one side with, some estimates of Chatham House saying 100,000 barrels a day of oil being stolen every day from this country, which is 100,000 barrels a day of oil being stolen from this country. It's kind of $6 billion a year or whatever of lost opportunity. At the same time, clearly, a country of 168 million people that has challenges on getting the economy to work for everybody in that nation. So we're seeing it in both places with slightly different connotations in those places.
Can I say a word
yes,
about that? Having been in politics, if you take my country, the Ivory Coast, I graduated from high school in 1980. I came back in 1994 in government, and from 1980 to 1984, the old school structural adjustment programs of the IMF stopped the Ivory Coast from building any high school. So in a country where population was growing at 3.8% per annum, there was no high school built for 14 years. First thing I did in government was to negotiate a loan to build 16 high schools. Part of why people know me in my country is that I did that very quickly, and these were the first high schools built in 14 years. So if you reach the age of 11 in the Ivory Coast and you had an IQ of 130, you couldn't go to high school because there was one spot for 10 pupils in high school. So when there was a coup, the soldier who arrested me, I asked him, I said, when were you, how old are you? He said, I'm 17, sir. Okay, he was born it was in 1999, he was born in 1982. He was exactly one of that lost generation. Mm-hmm. So you cannot conduct macroeconomic policies like that and then expect, we say in Africa, you cannot beat up a child and expect him not to cry. Those politics were absolutely senseless in countries that have an exploding demography. And the key to stability is to address those issues. We know the answer, we know the solution. If you educate the population, you don't get what you're getting now in the Arab world or in Africa. But it's, I think that's understood now. Why I'm more optimistic is that I think the international community has got that. But it's an investment that has to happen.
Well, of course, if you want to be optimistic, I mean, apart from the fact that Africa is now addressing some of those gaps, Mike Milken's slide yesterday showing the proportion of household income devoted to education in Asia, which was the second highest component of household spending, relative to America, where it's way down the bottom, was very thought-provoking in terms of looking at the longer-term trends. Yes, no education. Sorry, Willem, you were wanting to?
No comments.
Right, no comments, great. Well, in that case, why don't we turn to an issue which is not quite so encouraging as the structural changes in Africa and the emerging markets, which is interest rates. Because, of course, much of this return of confidence in the last year or so has been predicated on an extraordinary amount of liquidity in the global system. I mean, people are still arguing about how much liquidity is pumped into the system. You know, 10 trillion is an average number. Some people think it's a bit lower, some a bit higher. I mean, add a trillion, take away a trillion, you're soon talking about big numbers. But what happens when central banks start to take away that money and interest rates rise? I mean,
I think it's a luxury problem, right? Because it's only going to happen if the economy strengthens, right? So what do you want? Economy that doesn't grow with infinite liquidity, zero interest rates, or an economy that grows, which means the output gap closes, inflationary pressures come back, you raise interest rates. Long rates anticipate the increase in future policy rates, so they go up already. I'd say live with it, right? There's no alternative. The alternatives are much worse. I think markets are liquidity junkies. We know that. And they will take lots of liquidity and poor fundamentals in the short run over less liquidity and stronger fundamentals. But if you are not sort of a day trader, I think you look through that and you say, let's hope that the Fed starts tapering soon, right? Because that would mean that they have confidence that the economy is actually recovering. So I think this really is a non-issue.
So, okay, we're all wildly optimistic.
I give you a visual for this because I agree fully, which is, you know the rubber ducks that kids play with in bathtubs, right? The financial markets are the rubber duck floating in the bathtub. And the level of the water, the market, is driven by how much water is coming out of the faucet and how good the drain is. The faucet is the monetary policy. The drain is the economy. In Japan right now, the economy is not that great, but there's so much water coming out that the thing is floating up. The question is, when is the handoff to growth so you can turn off the spigot and it doesn't all come out the drain, right? And that is a big question, though.
The debate really doesn't make sense. We'll only be tapering if growth is back.
Exactly.
So how is that a problem? I just cannot understand. I'm in the same place.
Clearly, some emerging markets are exposed because their domestic currency long-term rates they always move in an amplified way whenever US rates move. But again, this is something that they should have been prepared for because after complaining about currency wars, you can't really also complain about currency peace. Right? So, and second, most of the problems that the countries have with these high rates are the result of domestic financial excess, which is under the control of these countries themselves. So again, while emerging markets are more affected, I think, somewhat adversely affected by this, it is again a luxury problem because it is accompanied by stronger growth in the advanced economies, which helps their exports.
And if I can add one thing, QE has been a huge transfer of wealth from savers to debtors. Okay, and that has to stop because it's fundamentally unhealthy. Saving rates in a lot of places need to go up so that there can be long-term investment and the economy can be financed healthily. So for me, removing it is absolutely good.
I want to turn to Anne in a minute and ask about the consumer impact of this, but sorry, Ed, you were...
I mean, I'm going to sound like a Philistine probably in front of this audience talking like this, but I mean, in the energy system, the time scales of 30, 40 years for investments we're making now that will come to fruition over the coming decades with energy demand in the world doubling in the next sort of 40 to 50 years, we have to look through these things and we can't get disturbed by the very short-term macro environment. Otherwise, literally, we're not going to be able to address the challenge of keeping the lights on and simultaneously addressing the climate change issue. So we have to take a very, very long-term view and look through some of these short-term challenges.
But when a company like Shell plans for the future, I mean, what kind of interest rate are you factoring in, say, for the next 10, 20, 30 years? Are you assuming that we've moved into a world of permanently low rates, or can you imagine a return to the 1970s?
So we have to plan. I mean, obviously, for us, we're very much managed on our own cash flow. So we grow our own cash flow to invest. There's relatively a small amount in terms of borrowings. But we do have to look for long-term scenarios. So as you may know, that we every sort of 4 or 5 years, we do a scenario outlook of sort of different cases, of credible cases for the macro environment. And we test our investments in both a sort of a high and a low case to make sure that we have got a robust investment climate to make those very long-term decisions. So we try and make sure our investments are robust in different
That's
different
called
levels.
artfully dodging the question. I'm really curious whether you're factoring in a 1% 30-year gilt or a sort of 10%, because
We have a longer-term norm.
Right, well, I won't keep pushing on that one. But Anne, in terms of the practicalities, I mean, are you concerned that rising rates could derail consumer spending in the US? Or
No, I don't think so. I think that you see when you look around the world, there's much higher interest rates in different countries, and they're growing faster, and consumers are more confident, and they're spending more. So I don't think so. I think also that consumers are spending on everyday spend, and they will use lots of different products and techniques. They may switch from debit to credit and to prepaid and so on. But they control their spending, in a way that it suits the environment. So it continues to grow. As I keep saying, sort of on a sort of global basis, consumer spending grows at about 5% a year, every year, more or less.
Every year consumer spending grows.
Yes, it's growing on average about that.
Right, interesting. Sorry, Alex, you were...
I was just going to echo your point to say that we've had lots of deleveragings in the last 30 years. We know how they work. They take a little longer when you got bigger deleveragings. So the story is kind of looking outside of the little cycle we're in. And yeah, it feels very painful, but it's been told many, many times before. So the question is, what will be attractive long-term areas to invest money? And do you have enough confidence that the whole thing holds together? And I haven't heard anybody say we're facing some existential threat. So I guess that might be a question for the panel. Is anything worry people here so much that they think this is a different story than anything we've ever seen before, given where we are today, not where we might have felt in 2008?
Well, I was about to turn the conversation to the banks, so that might be one answer. But before I do that, though, what would be your worst nightmare, Ed?
I think that the global economic system has got to hold together, and we need sort of stability in terms of policy from government. So lots of changes and immaturity, perhaps to coin a phrase that was used earlier, in terms of government policy would be very unhelpful. I think the instabilities that we've spoken about before in whichever region of the world would be extremely damaging. I also think, I would say this, wouldn't I, from an energy company perspective, getting the energy system right in the next 40 to 50 years is extremely challenging. And I don't think we've fully educated the entire population around how challenging that is, that the energy system of the coming decades is going to look quite different to the one we have today, and it's got to address the whole climate change threat as well as the keeping the lights on. So that for me is an extremely challenging. It's absolutely possible, but it's going to take some brave policy making and decision making from governments, which traditionally have usually a 5-year time horizon, when the energy system has a 30 to 40-year time horizon.
Right. Tidjane, what keeps you awake at night?
Oh God, so too many things to mention, but just to go with a few. I agree with the political threat. I think the political dynamics in Europe are worrisome. I think that there is a rise of the extremes. Potential instability is not only in emerging markets. I think there's a very toxic cocktail. The famous Merkel statistic, Europe, 7% of the world population, 25% of the world GDP, 50% of the world social transfers. Where is that going? And how does that one resolve it? So Jean-Claude Trichet the other day, he was saying everybody knows what needs to be done in Europe, but nobody can be elected on that basis. So that is a worry for me, because it's still an enormous mass of assets, and it could go wrong in a big way. And that's an area where I think we need some long-term approaches beyond the 5-year cycle with some real solutions and some structural reforms fundamentally, which I don't quite see happening yet.
Right, Alex, do you?
What keeps me up at night?
Yes, what keeps you up for hours?
I think the biggest tail risk is like an Atlas Shrugged moment in the United States, where basically people lose confidence in their ability to innovate given dysfunction at the government level, and that translates into uncertainty at the kind of monetary policy level. And then all of a sudden, the locomotive of the train isn't driving it. So what I mean by that is basically the Fed for the last, I don't know, Willem would know better than me, but probably for the last 30 plus years has been exporting monetary policy around the world that seems to have been mostly in the interests of the world. Now you've seen some divergence between what's in the interest of the US and Europe and what's in the interest maybe of the developing world, which is the growth. On top of that, the way Syria was handled, and now Congress, I think a lot of the world is looking at the United States and saying, we just don't understand how to predict how policymakers are going to navigate what comes their way. And then if it gets a lot worse, the Atlas Shrugged moment, you know, why do people want to be in the United States building companies? That would be a big tail risk.
Well, there's still plenty of growth in the United States, but...
I hope it doesn't. I don't think it's going to happen, but...
Well,
Yes.
the problem with the US recovery that we're seeing is that it is an old-style recovery driven by residential construction and consumers, and again, by consumers leveraging up. So there is no sign of public investment. Of course, the US is the worst infrastructure of any advanced industrial country. It makes the UK look like, I don't know, like Shanghai. And
Having come on the tube this morning, I had problems on the
there is
Circle
very
Line.
little private capital formation outside the shale gas and the tight oil section, and no real growth in export demand. So this is worrying.
I mean, I was going to say, on the shale gas issue, if you are changing structurally energy prices, what about onshoring? What about the growth of the industry? I mean,
So we're seeing obviously a very significant investment in the energy sector, but I think there's a very strong potential for a trickle down there, that you're going to get, you know, low-cost energy being brought on stream, which will onshore manufacturing of certainly energy-intensive activity. We're seeing it in refining already. I'm seeing it in chemicals already. So I think if we end up in a place where the US can export energy as well, there'll be quite significant investment.
Yeah, but it is a luxury, a sort of little extra. It is not going to create jobs, right? It's going to create wealth in the energy-intensive and in the capital-intensive industries. It's not going to bring back manufacturing of the Detroit variety.
I'd like to be a little more optimistic on the US. I happened to be on the US campus 2 weeks ago, and I was looking at the start of the year, and there's a lady who's paid full-time and goes around the world all year to look for talent. And she asked one of the young students to stand up, and she said, please, give him a round of applause because he's the first freshman in this university who applied from a refugee camp. And I went to talk to him afterwards. He was from the Western Sahara. So I've always seen the US as a bet on human capital. And that is not changing. And their university system has been enormously successful at attracting people. That's where I agree with you, Alex. If they continue to be able to attract that talent.
The university system is pricing itself out of the market,
no,
right? And
no.
For US citizens,
80%, I've told 10 universities last year, 80% of the kids, if you have the skill and if you're admitted, you find the funding. They all have endowments that allow them to do that.
Via debt.
Yeah.
Huge amounts of $1 trillion in student
The
debt in
real
the
cost
US.
of going to university
I saw a young
is out of
Indonesian,
the
I made
reach
him
of
an
a
offer
growing
after
number
10
of
minutes.
Americans.
He was so bright, okay? And if that system is able to attract those people and keep them, they will innovate. They will create wealth for the... certainly my money is more on that economy than on Europe that's building walls and think it doesn't need talent. I'd rather see an economy that pays people full-time to go around the world looking for talent wherever it comes from, and I believe in that model more than the European model.
I agree with that, but Europe, I think, is shooting itself in the foot by not creating the single market and getting the economies of scale, scope, and etc. But both continents could benefit from more immigration, I think.
What about the UK, which likes to think it lies halfway between the two? I mean, are you optimistic about the UK economy?
Yeah, I'm pretty optimistic. You know, as I said, we're already seeing growth here. Certainly, probably on the consumer side, 3 times faster than we see on the continent because of the sort of flatlining on the continent.
3 times faster?
Yeah, sort of. If this is growing at about 3%, the continent's growing about 1%. You know, but then you go across, as I say, to Eastern Europe, it's much higher. So you know, it's, I feel very optimistic in the UK. What I would say in terms of things that we worry about are, you know, governments are perhaps becoming more polarized around the world. I mean, consumers are becoming more similar. You know, we're all wearing the same stuff, we're drinking the same, you know, can of Coke, we're becoming more similar. But governments are becoming polarized, and they're looking at, you know, how they want to run their businesses in their own, you know, countries. And that's kind of can make it pretty difficult to run global businesses.
Right. Ed, quickly, I mean, given that we have not yet had a shale gas revolution in the UK, courtesy of a few small earthquakes around Blackpool and things, does that sort of affect your level of optimism about the UK economy longer term? Do we need to have shale gas to be able to compete industrially?
So funny enough, I mean, we were extremely disappointed, surprised with the government doing a big tax grab in the North Sea in 2011. I think much of that has been fixed, but I think there is a simpler, more effective regime we could put in place for our natural resources here in the UK. But we're investing about £2 billion a year in the North Sea, and in a bit of an unsung hero. People sort of often use the Mark Twain quote of the rumours of my death and an exaggeration. I mean, the North Sea is still a vibrant environment that we're investing pretty heavily in. So I see an energy infrastructure coming through from the North Sea, but also I think there is a potential for shale, but it's far, far too early to claim any victory on shale. If you look at the US, it's a 10 to 15-year journey to really understand the geology, understand whether it's economic, and then start the full production of shale gas. So I think there's a lot of hype around it, and it's far too early to tell here in the UK.
Well, that's quite sobering, because certainly since I spent a lot of time in the US, my impression today is shale gas today is what China was 5 years ago in terms of the one thing that everyone's grabbing onto as a source of great optimism. But Tidjane, what are your views on the UK economy?
I'm positive. I think that the UK is an open economy, which is for me the key characteristic and absolutely a prerequisite for all the rest. Here there is a debate about shale gas. In France, the government has signed a decree that just bans it. You can't even debate it without getting mobbed in the media. So it's fact. It's fact. So I think that the UK is in a good place because you ask yourself questions. You're an open economy. You accept to listen to people like me who have a terrible accent, and you put up with that. So I think that as long as you stay like that, you'll be ahead of the pack. That's a fundamental long-term thing, the openness and the pro-trade, open for the movement of human capital. Yes, all that is difficult in the short term. It may put the NHS system under strain, but in the long term, you will win. And those who know me know I love football. I just like the Premiership analogy. You have a phenomenal league, and I think ultimately it benefits the UK.
Well, I can't tell you how glad I am and how telling it is that we've managed to talk for almost an hour about the economic outlook and confidence without mentioning once the B word, namely banking. I guess the question is, looking both at Willem and Alex, are we assuming in this sort of generally optimistic scenario that the banking problems are fixed, that the ability of the financial sector to provide new shocks have gone? Looking at you from UBS.
Do I think the banking problems are fixed? Yeah. Of course, yeah, done. No, I think banks are, banks are embodiments of what will be periods in the economy that go up and down, and I guess it depends on the part of the world, but let's start in the U.S. Banks have delevered more, but they've got a lot of regulatory ghosts haunting them, like you see it with JP Morgan. In Europe, banks, I think they still represent something like 3+ times GDP of the whole continent. They haven't delevered enough, and the banks are the arteries, and they've got huge regulatory uncertainty. So there's a lot of unevenness depending on which country you're in terms of the banking story. In China, we mentioned the banks are probably going to need a recap at some point. That's going to be very tumultuous. So the banking story, even putting aside regulation and compensation and politics, has a lot of mechanical issues that are uneven around the world.
For 300 years, banks are great, but every 10 to 15 years they will blow up. Right. And every 10 to 15 years they will destroy 10 to 15% of your GDP, and it will take you 6-7 years to come back if you're growing at 1-2%. The problem is the narrative that's been sold to the public around that. It was not realistic. You could never get out of a hole like that in 2 or 3 years. It's a 6, 7, 8 year story, not a 2-3 year story. And I can make a prediction here with certainty. Banks will blow up again. Sorry, but it's a fact of life. As long as net you're on a positive trend, it's okay. What you're trying to do is minimize the cost of that when it happens. But I don't think anybody believes that we've now set up a system that ensures that banks will never blow up again. On the panel, there's a different view.
Well, I think America...
Well, that's your one note of not optimism.
Well, America has done rather well. I think in terms of its banks, I think banks everywhere need a lot more capital. But at least in the US, the banks have come clean by and large, and we're not sitting on zombies, right? And Europe still has a serious zombie banking problem, and of course in China the banks need recapitalizing when the government grants disguised as bank loans turn back into government grants, right? But I think these things are manageable. Europe will, under the stimulus, I think, of the asset quality review and the balance sheet assessment led by the ECB, force the banks to come clean and recapitalize. And once that's done, growth comes back. But no doubt, 50 years from now, we'll have another banking crisis, because that's the way...
50 years.
15.
15.
Because
or the clock is ticking.
Ultimately, there's no learning across generations in finance, right? But that's clear.
Right, exactly. Right. Well, the clock is ticking. Clock is ticking every sense. Yeah. Well, listening to you all, I mean, I have a few key takeaways. Firstly, that you are all, to a person, pretty optimistic, which is a very striking change from where we've been in the last few years. I mean, I can't remember a time, really, since before 2007, that there was such a consensus about the desire to be cheerful, whether or not it's justified. Secondly, within that picture, Europe remains a source of continuing depression, if not economic, then mental and emotional. Africa is a surprising source of optimism. China is still a complete mystery, I think, to most of us. And the US, well, who knows? I mean, let's hope that the shenanigans and the tantrums in Congress don't derail the recovery, although they certainly, if they carry on, will help to sell more newspapers on the front pages. But certainly there is some cautious optimism about the US, but there's potential for politicians to mess it up. So thank you to all of you for your optimism. I hope you're right. And I look forward to an interesting rest of the day. Thank you.
Ladies and gentlemen, breakout sessions will now be held in this room on level 29 and in the 2 meeting rooms up on level 30. Please consult your program for full details of the breakout sessions. Coffee and refreshments will be available on each floor. The sessions will start in 15 minutes. Credit markets at Crossroads is on level 29 here. Funding medical breakthrough, enriching society is on level 30 in breakout room 1. Wealth and power, energy in the world economy is on level 30 in breakout room 2. Ladies and gentlemen, the staircases are in the corners of the room on the opposite side from the stage. The staircase to the right is a staircase with a view. However, if you prefer not to have a view, please take the staircase to the left.